So Spencer, Gray Capital is launching its first fund, the Gray Fund.
Yep.
Why move away from like a deal by deal or single asset and go into a fund model instead of a single asset syndication?
No, that's a good question, because all of our previous projects that we've done at Gray Capital have been single asset syndications, and we really believed in a concept of working with individuals to help them to construct their own portfolio of cash flowing multifamily assets. Because as you know, I operate a family office or run a family office that heavily invests in real estate as well. And part of the philosophy of investing the family office was building our own portfolio. But we did start investing in funds at some point, and we learned about some of the advantages of that instant diversification. But for us at Gray Capital, it came down to really two main reasons why we're switching to the fund versus single asset syndications or single asset raises, or going deal by deal. And a lot of that was just our experience in 2021. First, that we didn't have enough room in our projects for all of the investors who wanted to participate. So we had a couple projects, each had about $5 million worth of equity each. And, for Suncrest, for example, we had over $20 million worth of interest within 48 hours with only $5 million available. Now, if we had a fund, we could take that interest and accept those contributions and go out and buy that real estate. Buy, instead of a $13.5 million project, we would go out and buy, a $40 million or a $50 million asset, maybe even a better asset. So one, it allows all of our investors, all of our partners to participate, to not be left out of a deal, because we kept not able to have enough room for each investor. But then the second reason, we lost out on some awesome projects, not because we were, a lower bidder. We were at the same price point, same terms as the competition. The only difference between us and some of the other groups that we lost out to is that they had funds and they had discretionary capital that they said, we've got the money in the bank, we're ready to go. We don't have to go out to the market and raise capital. Because we would tell brokers, we would tell sellers, like, look, we've raised $50 million, in the past couple of years. We can raise the capital. It's going to take us a couple days to get this thing locked up. But there's still a question there, at least in the mind of a seller. And so when they're looking at us saying we have to go out to the market, and another group saying we've got the money burning a hole in our pocket, they're going to go with the group that's got the money ready to go.
It does seem to solve one of the stranger parts of syndication, where you bid on something, you don't have that money, but you'll get it. But you aren't even allowed to talk to investors about it at a certain point. There are these limitations and as you progress through a letter of intent to kind of more formalized documentation, that the fund solves because you have all that money right there, and you don't have to meet that deadline, even if you have investors waiting to go.
It was a chicken and egg problem. We have to have the money to get the deal, but we have to get the deal to raise the money, because we don't want to bother all of our investors for each project that we would submit an LOI on. We're submitting LOIs, sometimes a couple LOIs every single week, and a lot of those don't materialize to anything. So we have to be under contract confident, so we're not wasting everyone's time. So this does solve for just being able to go much more straightforward, get those deals, get it locked up, but have our partners figured out, having the capital ready to go, so we can just move quicker, be more competitive. Because at the end of the day, we can, the Gray Fund's going to be $100 million worth of equity. We're going to go out and buy about $300 million worth of assets. We can raise all the money in the world, but if we, aren't competitive to win those projects, it's all for naught.
Yeah. So one of the other differences, and you've alluded to this in terms of the diversification associated with the fund model, is that these aren't single deals, so investors do not have that opportunity to pick their own deal. How would you kind of respond to that? Because as far as I know, investors like picking their own deals. And
again, this has been a process of, you've learned, each deal we do, we learn a little bit more. I've been involved in probably over 45 commercial real estate deals over the past 6 years or so. Almost all of those multifamily. Seen a lot of different deals, mostly value add or core plus strategies. No ground up development. But it's so difficult to pick out the home runs and the ones that aren't going to do that well. To be honest, some of the ones that seem like they're going to be a home run or no brainer end up, a wrench gets thrown in the gears and they're not as straightforward. They're not as good of a deal as you thought. And then some of the ones that are going to be, you thought were mediocre or average, end up being your best deals. Even when you have decades of experience and you've done, billions of dollars worth of projects, you still don't know everything. We have a limited amount of time to understand everything about each project, and you don't know how the market's going to turn. I mean, our property up, Villas on Fur up in Granger, Indiana. How would we have speculated that we were going to be essentially 100% occupied, for the last 12 months, or, we were going to increase rent the way we have? We would not have underwritten that. But on another project that you might be able to plug in some upside, looks really attractive as the returns look good, maybe there's a few more moving parts and it's not as straightforward. So what the fund does, it gives you more of the average over multiple deals. And so you don't allocate to the one that's a winner and miss out on the one that, or you allocate to the one that doesn't work out, but you miss out on the, the real actual home run. And so we're solving for, it's difficult to pick your own deals. And we're hoping that investors and our partners, they're looking at the Gray Fund because they're interested in investing alongside of us. We're putting our own money into the deal. We're probably co-investing 15 to 20% of the overall equity. I mean, it's $15 to $20 million. But they believe in the strategy. They believe in our track record. They've seen what we've done, and they want to, they want to build this portfolio with us. That's what we're doing. We're building a 7 to 10 unit portfolio with a group of investors, and that's how we're viewing it. We're looking at it as true portfolio construction, not just focusing only on one deal. We still have the same approach and strategy of the way we underwrite and analyze deals, but viewing it from the full portfolio allows you to plan a little bit better. And it also reduces risk.
Well, you could have a deal that looks great, but if you don't trust the company, and that's what, you read any book and they say invest in the company, not necessarily in the deal or the property. That's the most important factor.
People are everything, whether it's us or and even more importantly, I'd say than us is, who's on site, who's on property, who's that property manager, and then investing with a sponsor who knows how to control that and manage that whole process. It's all about who you're working with and not just any one deal.
So you did mention as one of the factors the ability to bid more competitively. How many investors missed out on deals in 2021 due to lack of availability, and how many deals, like I said, did Gray Capital lose out on because of lack of funds at the beginning?
I don't have an exact number of how many investors missed out on each deal because often we would just stop fundraising. And so we know a lot of people were thinking about it, but then they would get the email that, we're no longer accepting contributions, or we're no longer accepting investors for these projects. But for each one, you saw these things coming in, Matt. It was quite a few for each project. And again, we'll still get messages. We got some, from past projects recently saying, can I still invest in this project? But like on Suncrest, we had over $20 million worth of interest. We could only accept 5 of that, so $15 million wasn't able to be allocated. And then for the deals that we miss, unfortunately, that's a long list. Probably, I'm just adding things up, probably around $300 million worth of assets, so kind of the value of the fund that we're trying to do, the portfolio we're going to build. We lost out on a lot of great projects. Some of them we lost because we weren't willing to speculate as much as another group. Our return, our thresholds are a little bit higher than some other capital out there. But some of it was, like I had mentioned earlier, we had same price, same terms. Another group had the money in the bank and we didn't. But also having the capital raised and ready to go, it does allow us to move a little bit quicker, because there's sometimes where you don't necessarily need a full 90 days to close. We can get things done. Our team moves faster than just about anybody. How quick Jay works. He's the best transaction guy in the industry. And so sometimes it can be the difference between, we can even get a lower purchase price compared to other offers if we can move a little bit quicker. Talking to George Tikajan and Hannah Ott, last year, one of the biggest differentiating factors and biggest changes is just speed of execution. So if we can speed up our time to execute, we know that we can take down more projects, and it doesn't have to be that we have to overbid. It's just we have to be the ones that can execute. And luckily, we've got a good history and a good reputation of executing. So this is only going to make that better.
That's interesting. So that kind of speaks to the strategy and how you got and how Gray Capital has gone about acquiring assets. Is the Gray Fund targeting different types of assets or pursuing a different strategy than you have historically?
Yeah,
or is it very similar?
That's a good question. It's really similar. We're continuing to do what we think works. Now, the differences, which really aren't that different, is just we're trying to be on top of the market and be ahead of the market. And so that's related to, how much value add and how much the types of renovations that we're going to be pursuing. We're kind of right in between that value add and core plus kind of risk and return profile, usually getting kind of value add level returns, core plus risk profile. Mm-hmm. And with supply chains, labor costs going up, it's not that things are more expensive. It's just you can't even get the materials, you can't even get the appliances to do some of this work. So we're looking a lot more at operational value add, as well as just organic, mark to market, taking the in-place rents up to market rents, which is, anywhere between 15 and 30%, depending on, the submarket and the property itself. Running things a little bit better, making things more efficient, adding amenities to trying to differentiate ourselves from the competition. We're not always convinced that just throwing in a granite countertop is going to get us, a $200 rent bump each time, and it's that easy. So trying to be smart, working smarter rather than harder, and really looking at what the ROI is on these renovations. Because, again, if I can get a $50 rent increase by spending, $1,000 or a couple $1,000s, that's a lot better than getting a $100 rent increase after spending $10,000.
Yeah. So would you say that that the fund is more value add focused, or it seems like you're saying that because of the supply chain issues, the renovation heavy projects are less attractive from an investment standpoint?
To be honest, they were slightly. We're not afraid of a renovation, but it's more of the wholesale systematic. We're just going to go in and renovate every single unit. Regardless of what we think market is and where the condition of the current units, and just doing it to do it. Yeah. We're trying to find opportunities, what's really going to move the needle, and sometimes that is a full scale renovation, but we don't think it always is. And so it's really being more tactical and surgical and seeing where we can spend money that's going to move the needle the most, how much leverage we can get from those renovations, rather than just using a cookie cutter and doing the same, scope on each deal.
Yeah. So are these similar then projects, and can you kind of speak a little bit, and I know you've covered them in brief, about the types of projects that Gray Capital pursues typically, and your track record really is what I'm interested in.
Yeah, because it's the same strategy, same type of assets that we've been going after, for years. And so specifically for the fund, and this was the same prior to the fund, projects newer than the mid 80s all the way up to brand new. But really what that means is we want to find projects with minimal to no physical obsolescence. So it may have been built in 1985, but if we can renovate it to a level where it seems newer or modern, it doesn't seem old. When you tour an apartment that was built in the 60s and 70s, it feels like it was built in the 60s and 70s. Yeah. Not that a property built in the mid 80s seems like it's brand new, but there's the way that they were starting to build properties in the 80s is a little bit more modern, and it feels a little bit more at home. And through some targeted renovations, you can really get the same similar experience than you can at a brand new asset. Yeah. And so focusing on slightly newer, doesn't have to be brand new. Stabilize assets. So typically we're looking usually at least 90% occupied. We'll go down to 85% occupied if it's trending the right direction. So nothing that's completely distressed, that's falling apart, that has just absolute horrible issues. Mm-hmm. And the reason for that is we're trying to generate cash flow from day one. Yeah. Looking for that good balance, the appropriate risk premium. Because we're fine with taking a risk, but we want to be compensated for it. Yeah. And a lot of the distressed properties today, you're still getting a premium for that distressed asset.
Yeah,
There aren't
yeah.
really any distressed assets out there.
Yeah.
So it's like I might as well buy one that's going to be paying us and paying our investors from day one, that we can continue that momentum and really move it to the next level.
Yeah. So, okay. So then, what is your attitude then towards new development, or are you really only interested in existing properties?
So we're not going to be doing any ground up development in the Gray Fund. All existing assets, all stabilized assets. I get asked this question all the time. Are you guys going to be developing? When are you going to be developing? And it's something that at some point we'll go down that road. But right now we're really focused on repeating what's been successful.
Yeah.
We found something that's worked. It's working really well. We keep repeating it, doing it over and over. I mean, we've invested in now over almost 10,000 units. Collectively, we've sold a lot of them. But we've invested in a lot of deals.
Yeah.
And we've seen what works and what doesn't, what works better. And so we're really focusing on what's been successful and doubling down.
That definitely makes sense, and seems to fit the idea of wholesale renovation. How about a wholesale building of an entire property? It seems like a lot of risk.
It's a different skill set.
Yeah.
It's a different skill set. It's a different risk profile. It's truly opportunistic. And frankly, a lot of the returns out of a lot of those ground up developments to me don't justify the risk. Now, if you look at the result over assets that were just delivered the past couple of years, valuations have gone up so much that you're hitting great IRRs on a lot of the new development that's being sold today that's been built the last couple of years. That for me, we're focused on cash flow, and going 2 or 3 years with no cash flow.
Yeah.
To me, that's just not the return profile that I'm pursuing or our investors are. But at some point, will we build something? I'm sure we will, just not this year.
Okay. Yeah, that definitely makes sense. So I've talked a little bit about the strategy and the properties that you're pursuing. What about the specific markets and locations that you're looking at?
So, we're headquartered in Indianapolis. A lot of our portfolio is in Indianapolis. We love Indianapolis, and we're going to continue to invest here in Indy.
Yeah.
And that really goes for the state of Indiana, larger markets such as, Fort Wayne, Bloomington, Lafayette and West Lafayette, Evansville, South Bend, Granger, Mishawaka, MSA. All these markets are growing markets, dynamic economies. Most of them besides Indianapolis are more tertiary. We find that we can find some really nice returns in those markets, and we know those markets. It's not like it's somewhere random on the map. Other markets that we're really focusing on, again, mostly Midwest, because those are the types of cities that we understand. In addition, we feel as though that's where the most opportunity is, because they're not always being pursued by institutional capital. It gets us a little bit higher cap rate, more cash flow. It's a different return profile. If you invest in the Southeast, you have to be speculating on upside. You're not going to get any cash for the first couple of years. You may get a killer IRR, an equity multiple. Our IRRs and equity multiple in the Midwest are similar. It's just more of the return is weighted towards cash flow and income rather than all upside.
Yeah.
So Indianapolis, a Louisville, Kentucky, a Kansas City, a Cincinnati, Grand Rapids, Michigan.
Okay.
Those are the types of markets that we're going to be pursuing. And, potentially like a Tucson, Arizona. We're not going to absolutely put ourselves in a box and saying, okay, there's a deal in Chattanooga, Tennessee, or Knoxville, Tennessee, or even a Tucson, Arizona. We may pursue, there's a good chance we could pursue some of those opportunities.
Anything in the Southeast that you would be interested in, or is that very competitive?
It's so competitive. That's not where our competitive advantage is.
Yeah.
Again, if we can find an opportunity, have the operational capacity to get down there and get a beachhead, we would never say no to a great market.
Yeah.
But to go into Atlanta or Houston or Dallas right now or Austin, there's other syndicators there, and folks should invest with those guys because they know those markets better than us. The only reason I even mentioned like Tucson is because I have family out there and I go to Tucson, and so we have market knowledge, and we like to invest in places that we really know, are comfortable with, where we can exploit the market inefficiencies of others, just not knowing what's going on in a particular market, but that we do know. That's a way that we can drive returns in a way it's hard to underwrite.
Okay. Yeah, that definitely makes sense to know the whole story of a market firsthand. So shifting focus a little bit to the Gray Fund itself, can you explain the structure of the Gray Fund and how, if I invest after a certain amount of period, am I investing in all of Gray Capital's projects, all their existing properties, or what? How does that work really?
That's a good question that we get asked a lot. So you're not investing in Gray Capital, the company. You're not going to be investing in all of our existing assets. If you go on our website right now, we've got a lot of beautiful properties. Those are not what are going to be going into the Gray Fund. The Gray Fund is going to be comprised of new assets, 7 to 10 newly purchased, newly acquired assets to Gray Capital. So not new construction, but newly acquired.
Okay.
So these are going to be fresh assets, not just recapitalizations.
Okay. In the past, Gray Capital projects, you had 1 or 2 classes of membership units. Now, this is a little bit more in details. It's my understanding that the Gray Fund is offering 2 types of units, A units and B units. And can you kind of explain the difference between and the advantages of separating it into these kind of...
So you're right. In the past, we've had a very simple economic structure, preferred return, 7-8% typically, and then usually like a 70-30 LPGP split. For the fund, we're doing things a little bit differently. It sounds complicated at first, but it's really advantageous to investors and allows the fund to be more flexible also. So we, like you said, we have 2 types of membership units, A units and B units. And the easiest way to think about it is A units are really focused on cash flow and income. If your focus and your return goals are around generating income, the A units are going to be the best units for you. The A units have a 10% preferred return. It's going to be distributed monthly. It's in a priority position. And so if you don't care about upside, you've got $1 million to invest, and you're like, I'm fine. I just want to keep the $1 million there, and I want to earn $100,000 a year off of it, tax sheltered. That's the A units.
Okay.
The B units are for investors that are really just focused on upside. They care less about the income. They've got so much income from other sources. They're trying to get the highest multiple or IRR possible on their money. And we're able to achieve higher than normal IRRs and equity multiples on the B units because those A units, the upside is capped at 10%. So you get the 10% preferred return, but no further upside. It also only makes up, the A units, only 25% of the equity. So all that upside flows to the B units.
Okay.
So there's more cash flow for those B units. Now they're positioned behind the A units. So technically the A units are slightly lower risk, but slightly lower return.
Okay.
So that's kind of the first way to look at it as separate buckets. You've got your A units and B units. I'm focused on cash flow or I'm focused on appreciation. Almost none of our investors are only focused on cash flow or appreciation. It's always a balance.
Yep.
And so this is the way I prefer to look at it. Instead of looking at one bucket A, second bucket B, you look at tailoring a blended return, being able to create a tailored, bespoke return profile using these 2 different types of units. So, for example, you say, I really like to receive an economic structure and return profile similar to your past projects where there was 8% preferred return, 70-30 split. If you do 3 units of B and 1 of A, you're going to get a preferred return that's just under 8%, combined with the 10 and the 7 of the B. But it's basically blended to just under 8%. But then you're still getting that 80-20 split that the B units have.
Okay, yeah.
And so you're still getting the upside. You're still going to get projected IRRs in the 17-18% range. And so it's a way to really, again, tailor a customer return profile. If you say, I'm mostly focused on cash flow, but I still want potential for a little bit of upside, maybe you go 50-50, 2 units of A and, 2 units of B. And we can help partners, our investors, kind of figure out what's right for them. We've got different allocations modeled out of what those return profiles look like.
Okay.
But as every investor, they're a little bit different. And then there's no reason why you can't start with 3 of B and 1 of A, and then decide, hey, I need a little bit more cash flow next year. I'm going to buy another, A unit.
Okay. That definitely makes sense. So then what would be the minimum investment? How much does one unit cost?
So one unit's going to cost about $25,000, but the minimum investment is $100,000 for the first 6 months of the fundraise.
Okay.
And so that $100,000, that's going to be split up between all the assets in the fund itself. So if you really think about it, if we go out and if we do buy 10 properties, it's going to be between 7 and 10. But if we buy 10 assets, the $100,000, that's essentially like if our minimum was our minimum was $10,000 per project.
Yeah.
You can't find that minimum just about anywhere. And so it allows someone to be diversified with actually a smaller amount of capital. Now, after the first 6 months of the fundraise, we're going to be raising the minimum to $250,000 per project.
Okay.
If you think about that, that's still like $25K per deal if we do 10 deals.
Yeah.
If there was a minimum, if you were doing it deal by deal. And so this allows an investor to get instantly diversified across multiple high-quality, stabilized cash flowing assets with one investment. I know a lot of groups, and I've done this too, and a lot of our investors, they're super smart and sophisticated. They're building their own portfolios. Underwriting 10 deals, probably with multiple sponsors, different markets, that's a lot of work.
Yeah.
10 PPMs, doesn't take that long to sign a PPM, but it kind of does.
Yeah.
It all adds up. And even if you are picking deal by deal and you're building your own portfolio, which I think that you should do, an allocation to the Gray Fund or any fund really gives you that instant diversification. So maybe you've picked out 5 deals on your own. You're into the fund, now all of a sudden you're spread across 15 deals. That level of diversification, your level of risk decreases so much quicker than if you were just in a handful of deals. And 5 deals really isn't enough, too. Mm-hmm. The way we've looked at this, if you look at the risk curve of diversification, you really need to be within that 5 to 10 deals. That's why we're doing 7 to 10, because 5, you start getting some of the benefits of diversification, but you still have single asset risk. Mm-hmm. Once you hit 10, you're really there. 7, you're 90% of the way there. And then after 10, the returns are diminishing of how much benefit diversification gives you. Really, 15, 20, it's not much better than 10. So we encourage everyone to get allocated to 10 deals in general, whether it's in deal by deal or a fund. I think for most people, it's going to be difficult to get into 10 deals, deal by deal. You got to find the deal, $50,000, $100,000 minimum. That's a lot of money you're going to have to outlay versus $100,000 minimum on the Gray Fund.
Okay, that makes sense. So, and you've explained this a little bit. The Gray Capital's previous minimum was $50,000.
Yeah.
Is there a specific reason why you're increasing it to $100,000, and why $250,000 after 6 months?
Yeah, part of it is just our investor base. The profile of our typical investor has changed a little bit. We have a lot of ultra high net worth and family offices investing with us now, and I get more questions of your investment minimum is really too low. 100 is too low, 250 is too low, and surprised that we're taking allocations of $100,000, $250,000 because these are folks that are investing $5 million, $10 million per project or into the fund, and so they're just much larger, either institutional or family offices. We've had so much demand. We want to take more time to be able to focus on the partners that are invested in the deal, and coming up from 100 from 50, that allows us to focus more time on the investors that are invested in the fund. And again, like I said, if you break it down on a per deal, it's actually a much lower minimum if you look at it on a per deal basis. Okay.
Yeah, that makes sense. So how about fees?
Yeah.
Is this just an excuse to load up on fees? And it's always kind of a cloud that hangs over it. If you could kind of clear the air to continue the metaphor, what's the frequency? Or I'm sorry, what is the fee structure there, and how can you kind of describe it?
Yeah. So our philosophy on fees is we need to charge enough to keep the lights on, keep everything going. How we're going to be making money in this fund is not on fees. It's because of our performance, and we're investing our own money into the project. Fees are actually going down compared to our previous structures. So we've gotten rid of some fees. We've added a new fee. We've tried to mirror some other funds, but try to do things our own way at the same time. So like for like acquisition fees, for example, we've charged anywhere from 1% up to 2% in the past. We're going to be in the 1 to really 1.5% range for our acquisition fees. We may even go down to 0.75 on some deals, but 1.5% is going to be our max for acquisition fees. We've removed our asset management fee. We've gotten rid of it, but we do have a fund administration fee. You could call it an asset management fee, but we've moved it of where it is like in the line item.
Yeah.
And so it's 1.75% of deployed capital. We're changing that we were charging a 2% asset management fee. In terms of property management fee, we're not going to charge anything over than 3.25%. Most likely it's going to be 3.75%. Most likely it's going to be 3.5 to 3.25% on property management fee. And then in terms of the waterfall, this only really is applicable to the B units because the A units are capped at the 10%. But for the B units, 7% preferred return. And again, that's in the second position behind the A units, but 7% that'll accrue. It'll distribute. It may not distribute the 7% every month. And then there's an 80-20 LP-GP split after the preferred return, which you see 80-20 more on venture capital, private equity, not as much on real estate. You see 70-30, but we've got 80-20. That goes all the way up to an 18% IRR. Once an investor hits an 18% IRR, it goes to 60-40 LP to GP.
Yeah.
So we're really not getting into our promote until we've exceeded an 18% IRR. And that won't take place until at least year 5. So our term is 5 to 7 years. And so, one method that some sponsors could do is shorter hold period, you can get your IRR up. But having that 5 to 7 year hold period for the fund itself, we have to perform. We can't just be turning deals so quickly just to get an artificial IRR threshold.
Okay. Yeah, you mentioned the 80-20 LP-GP split. What was the previous split in your previous syndicated deals?
70-30.
Okay.
For most of the projects.
Yeah. So how often then will you be reporting and offering distributions for those units?
Yeah. So we'll be communicating monthly, but we'll issue quarterly official reports for the projects. And we'll also be issuing distributions on a monthly basis. So again, those Class A units getting the 10% preferred return, that's going to be distributed monthly. And assuming that there's going to be enough cash flow for the 7% of the B units in a given year, those will also be distributed monthly, assuming that cash flow is available.
Okay, and is that different from before?
Yeah, so we've been doing quarterly before,
okay.
So we're moving up to monthly. We keep getting demand from investors, and we figured, why not? Who doesn't like getting paid?
Yeah, exactly.
Once a month versus 4 times a year?
It is.
So,
I agree.
who doesn't like checking their bank account?
Exactly.
Distribution?
It's true. It's a lot nicer every month to have it. So I'm sold. What would be the process if I wanted to invest today?
Yeah, so if you're already an investor with us, you can reach out to myself or William, any of our investor relations folks at Great Capital. You can also just go on greatcapitalllc.com. There should be a button right there pointing you to the Gray Fund. If you have access to the Great Capital Investment Portal, you can go on there. It's live or will be live soon in the investment portal, I guess, depending on when this goes out. Because we haven't launched just yet. We're getting ready to launch. So greatcapitalllc.com, and we'll be pointing you in the right direction.
All right, great. Thank you for talking with me, and I appreciate it.
Hey, thanks, Matt.